as well. So it's fantastic to be at an event like this. It's great to see the roll-up, and just like Nicole was saying, what better reason for people not be able to get to an event than it's rained. And the quantum of, the amount of rain you've had, the last 10 days is, it's hard to imagine really in the context of what you'd normally get annually. But as exciting as that is, it also highlights the challenge, doesn't it, about how volatile our weather patterns can be, but also how important it is that we keep thinking about what can we do to be more resilient, what can we do to be more better planned, what can we do to be in better shape regardless of the weather. And I think that's one of the big challenges. It's a good thing we don't have the presentation police here, because I'm way off track from what I'm supposed to be talking about. But I think what it highlights is some of our big challenges are, how do we actually be better prepared to manage and respond regardless of what's put in front of us, rather than the things that we know are probably going to happen positively or negatively being the things that drive our fortunes. And part of what I will talk about today is the massive shift that we've seen in the industry in the last 20, 25 years. It just conveniently coincides with how long MLA's been in existence, and the two things are only loosely connected. It's the broader industry effort that's happened in the last 20 or 25 years, which has put us in a materially different position. And when I was putting these slides together, the guys who do the projections, so the projections update came out yesterday or today. It was finished yesterday, I think it's coming out today. So I've actually got some slides in here from the projection stuff which hasn't been released yet about our numbers and volume. And we always put in currency slides, right? What's happening with the currency. But I actually took it out of the handful of slides I used today, because the currency, like the US currency, is nothing like the impact on the fortunes of our industry today than it was even 5 years ago or 10 years ago. Because when we had a commodity product, and that commodity product was sold on a head-to-head competitive basis with a bunch of other commodity producers and sold in US dollars on an immediate delivery basis to competitive countries around the world, the US dollar was really important. We actually don't do that anymore. We actually don't produce or sell our product like we did even 10 years ago, let alone 20 years ago. And I talked about this a little bit last night, but 20 years ago, if you look at how fundamentally different our industry is now to what it was 20 or 25 years ago, and 2018-19, those two drought years, gave us the best evidence of how much things have fundamentally and materially changed to what they were a couple of decades ago. So in those 2 years, the worst two weather years known to man in Australia, right? We have never had 2 years that bad across the country ever before. But all of our commodity prices were at or above 5-year averages. Now, historically, when we've seen that type of situation where we've had terrible environmental conditions, we've had increased turn-off, the first thing that happens is prices crash. Because we've got oversupply, we don't have a strategic connection to the rest of the supply chain. But through that whole period in 2018 and 19, all of our commodity prices were at or above 5-year averages, even though we had the highest turn-off of cattle and sheep that we've ever seen in the history of producing livestock in Australia. Right? So what's materially different? Why did that happen? At a very high level, macro position, we actually have a much more sophisticated supply chain. Whether we like it or realise it or notice it or not, regardless of where we now sit in the supply chain, we have a much stronger connection to a higher quality consumer. Now, as cow-calf operators or as backgrounders or as feeders or as traders, we might think, no, I don't, I just buy and sell. Well, you might just buy and sell, but you're buying cattle that are actually being produced in a different way. You're buying cattle where the genetics are actually focused towards producing a high value, high quality, more consistent product. You're buying cattle which are being produced to be traded, to be sold as feeders. You might just be selling them, but you're selling them into a market that's looking for feeder steers. They're looking for cattle to finish on grass. They're looking for cattle to go into a feedlot program. The reason why middle of last year we had more than 50%, and if you get this version from the feedlotters, it's more than half of the turn-off and half of the industry is now, beholden to the feedlot sector. It's actually not quite that, but 51% of our cattle in that first quarter of this last financial year were turned off out of the feedlot sector. Not because everybody's now decided to be a feedlotter, but because of the conditions that led into that, coming out the back of those dry years, the availability of cattle, having to have more younger cattle go into the system to meet market requirements, we ended up with more cattle in feedlot so that we could actually guarantee the consistency and continuity of supply. That was the driver. Right? So more than 40% of our turn-off is actually now coming from feedlots, which is driven by the demand from our consumers and customers all over the world. So what are the drivers of this? Look at a couple of differences between now and the mid-90s. In the mid-90s, we had one free trade agreement with New Zealand. So if I asked you just to, quick quiz, who's our top 5, red meat customers around the world? New Zealand is not going to make the list, right? If you were going to put it on your list, you need to adjust. It's not on the list, right? We had one agreement with New Zealand. We now have 16, right? 16 free trade agreements. The UK FTA, which should come into force on the 1st of July next year, it's the 16th that comes in there. On the 1st of July, and it's highly likely that's when it will come into force, it will add $1 billion of market access for us. $1 billion on day one. On day one, we will have more access to the UK than our largest year of exports to the EU, the whole EU, in the last 50 years. So we hear about the UK FTA and it's all very interesting. It's a big deal. So we're already in a position where we've got some of the best trading, demand, supply conditions that we've seen, and July next year we're going to have $1 billion worth of extra international demand opportunity added to that. And we've got 15 more of those along the way. We now have preferential access to the US, to Japan, to Korea, to China. And a bunch of things about those agreements is that we're in there first and before many of our competitors. And one of the things that we probably don't realise is that in our more recent agreements, there's these things called most favoured nations clauses. And it was a thing that Andrew Robb did with the China deal materially, but then it added on to a few others. And it's this clause that says, we will sign, in short, we will sign up to this now, and even though it's not exactly what we think is the perfect deal, if you do a deal that's better than this with anybody else, then we immediately get that deal. So what it allows us to do is it allows us to sign an agreement quicker, which is now what we've done in the last 3 or 4 free trade agreements, but then know that as long as we have got as good or better deal than anybody else, we can blast away because we know that we're then going to maintain that position. Because if they do a deal with anybody else that's better than ours, then we will automatically get access to that as well. So what this has done is that in the last 20 years, we've shifted from this highly competitive commodity production system to one now that's got preferential access to the highest quality, highest value consumers around the world. So not only do we now have that access, but in 25 years ago, we didn't have a traceability system at all. Well, we did, we had tail tags, right? So imagine when we think about traceability, if our traceability was just tail tags, right? That was it, that was our traceability system, which largely was connected to property identification codes, and anybody who understands how loose that might have been is probably thinking, oh yeah, that's right. We didn't have a quality assurance system, now we have. And whether we like these things or not, or whether we think they're perfect or not, they have a material impact on our ability to trade. So having traceable, quality assured product puts us ahead of pretty much everything else. We have a meat grading system, so MSA covers more than half of our production. But more importantly, and absolutely more importantly, the science from the MSA program is applied to every animal that's actually produced and processed in Australia. So the average quality of our product coming out of the system, even our commodity product, is significantly better than what it was. So we've now got a high quality product that's traceable, that's quality assured, that's got preferential access into the highest quality markets with the most discerning consumers around the world. So you add to that we've got low stock numbers, you add to it that we've got a good season, you add to it that there's growing protein demand around the world, You add to it that there's a 50 million tonne protein supply hole as a result of African swine fever, and things are actually in pretty good shape, right? And one of the things that I'd like us to do as we go forward is to stop being surprised by this, because it's been as a result of the industry efforts. As an industry, we've done all these things over the last 20 or 30 years, and the whole aim has actually to be better, to get better, to produce better product, to get it to high quality, high value consumers around the world, and that's actually what we're now doing. Now, we've got an increased peak in price because of the supply and demand challenge that we have. When we're normally turning off 8 million cattle and we turn off 6, that has an impact on supply, right? And that's obviously driving some of the increase in price. But what we've also seen in the last 18 months is we've seen a progression or a play out of our pricing structures that doesn't reflect anything that we've seen before. And what I found very frustrating, but then a bit amusing, over mostly last calendar year, and I think it's got a bit better this year, was the commentary. So we had a lot of this traditional commentary about our markets that were saying, well, we've had a drought, and now that we've had some rain, that now means this is going to happen with the market. Because that's what's happened every other time. Completely ignoring all that stuff that I just talked about before. And then the price would keep going up, and they'd say, well, there's going to be a crash. So at $8.50, when the Equi's at 850 cents, we had people saying, this is unbelievably high, we're going to see a crash. And it goes to 900. We've never seen this before, there's going to be a crash. It goes to 950, which I thought was going to be somewhere way past the peak, and it sort of blows past 950, it goes to so we get past 1,000 cents and people start saying, maybe it's not going to be a crash. Because what we were seeing is we were seeing analysts who were saying the price is going to go down because the price has gone up. Now that's a pretty simplistic view of the world, like gravity. Right? A bit different to what I was describing before, which is actually now the state of our industry. So why to talk about all that? So the opportunity for us is just fantastic, right? It's just fantastic. We're out of this cycle of booms and busts. We absolutely are. We'll see volatility, we'll see variation in price, but the drivers on not just the pricing, but the profitability of our supply chain is now fundamentally different than what it's ever been before. It's more secure, it's more reliable, more predictable. We've got more control over how we actually then connect and engage with that. So we're in much, much better shape than what we've ever been before. So great opportunity for us, and there's none of these big macro drivers are going to change in the next 3 to 5 years. But more to the point, the fundamental base and driver on why and how we do that now is different as well. So even if some of these macro drivers do change, we're still going to be in much better shape. We'll see variation in price, but we're not going to see crashes like we've seen before. There was an article a few months ago, which was, and I think I mentioned this to a couple of you last night, about prices, and there were processors saying, we're losing $350 a head on these cattle because they're so expensive. Now, I'm sure there's nobody in this room that still hates a processor, but we've got this antagonism between production and processing still. And normally that argument would be made around, we're not making any money, these guys are making money, we need more of their money. So when I read that, fortunately for me, it was a month after I'd been with my brother and I went and spent some time helping at Mum's to sort of clean up a few livestock and things, and we'd sold some feeder steers. 18-month, 20-month-old feeder steers, Santa Crosses, off grass, low cost of production, and I don't know what they weighed in the end, but they returned $2,250. So look, righto, so if Mum's feeder steer is worth $2,250, we can actually give the processors their $350 if that's what they're losing. We can actually give them another $100, because if every processor made $100 on every animal, they'd never be processing on a Saturday because they'd be digging holes to bury their money. So we can happily give up our $400 and we're still making $1,800 on a feeder steer that's probably cost us $500 and a little bit of change. Right. So it's like, hold on. So we're now at a position where there's actually enough money in the supply chain for everybody to do incredibly well. And we've actually never been in this position before. So you're probably gathering I'm a little bit positive about the prospects for the red meat sector. And the difference now is that I've always been like that, right? So I've always been the ridiculous glass half full. Just now, 30 years later, we've got all this fantastic, weight of evidence that supports that. So we're in incredibly good shape. We absolutely have to stop being surprised by our success. Because collectively as an industry, this is the path we've been on to get us to this point. Just one final thing where we'll flick through some of these slides. We're having a discussion a few months ago with a few producers, a few producers that were, there's just a centipede near your foot there, just step on it. Just under your bag. And we're talking about prices across the industry. And we answered all the questions, and we eventually got to this point where this one lady said, well, the problem is my mum now can't afford to buy eye-fillet steak at the supermarket. I said, okay, because the price keeps going up. And she's like, what are you going to do about that? I'm like, well, actually nothing. Because that's actually the plan. It's actually always been the plan. But I think it's now us getting used to the fact that we have a high quality and high value product. And we shouldn't be ashamed of that. Right? What we have a challenge now of is how do we keep people happy that they're now paying significantly more for one of their most favourite proteins than what they've paid before? How do we find ways for them to get better value out of that? How do we find ways to connect with them, to keep them buying the product, but finding different ways to do that? So different cuts, different product utilisation. Our product development needs to go into how do we have a lower cost per kilo item that still gives somebody a good eating quality experience and still provides margin for the system. So we've got different sets of challenges that we need to focus on. But this high retail price is something that we absolutely should be proud of, and our efforts need to go into how do we find ways to better utilise that. Okay, so I just want to quickly talk about our strategy, some of the supply stuff, our key programs of work focus areas, and then how we report back. The industry has a very structured plan around how we think about what we're investing in, why we're investing in things, and where our efforts should go. So there's a Red Meat 2030 plan, which was a broadly consulted program. It's got these 6 programs of work. It actually feeds into our strategic plan, so we use this as the guiding light. We have a 5-year strategic plan, then we have a 1-year annual investment plan. So one of the challenges we now have with engaging with groups like NABRAC and ASPIAC, for example, is as we get more focused and we get bigger programs of work, how do we make sure we keep that connection with the grassroots and operational input? So we're not in the position where we're trying to solve this massive, great big long list of challenges anymore. We're trying to funnel through into smaller, larger programs of work. But where one of the most important things comes in is how do we actually bring the benefits from that and actually get those, increase the awareness and increase the adoption of what's coming out of the system as well. So these are the drivers behind the MLA plans, and this is out of the Red Meat 2030 plan, so double the value of Australian red meat sales in a 10-year period and be the trusted source of the highest quality protein. So we can double sales by increasing volume or increasing value. We think it's a good idea to do both, and so our focus is on a combination of those things. When we look at our supply and demand, these are our global markets, and I've talked a bit about these, and really consistent, our big demand markets. So North Asia, Japan, Korea, North America with the US. China is a market that gets a disproportionate amount of press, where 10 years ago, so 2 years ago, China was our largest market, 270,000 tonnes. Last year it was our number 4 market, 150,000 tonnes. Anybody want to have a guess at how much we sent to China 11 years ago? Yeah, Luke did that, but that's right, yep. So less than 5. Okay, so what it shows is our ability to flex. So we send to 100 markets. So everyone talks about the disaster in China the last couple of years. And yes, we've had a reduction in volume to China, which has been about 50% more than the reduction in other markets because we've had a big decrease in the available product. But still our number 4 market. right? So it's still been a very important market to us, but we haven't seen any impact apart from at an individual processing level when people have got product labelled to China and then they can't have to send it somewhere else. That costs them, right? But otherwise, we've largely been able to move to other markets without any impact because we've done this before. Right? We used to send 50,000 tonnes of product to Russia, and after they shot down MH17 and we said we don't like it when you shoot down passenger planes, they said, well, if you don't like they're going to shoot down passenger planes, we're going to stop you sending beef to Russia anymore. We lost access to 50,000 tonnes overnight. Didn't have an impact on sales or price or value of livestock because we had other markets to go to. We're very experienced at actually how, as an industry, about how we actually manage and flex around our market. So the China piece has really not had an impact. And there's three very different things going on in China. There's the political discussion over here, then there's what you actually read in the press, and then there's what's happening on the ground. These three things are not really connected. So we have a very, very strategic approach to red meat sales in China. Keep your head down and shut up. The trade relationship is incredibly strong, and that's actually what we've seen come through in the last 18 months. The importers and exporters have a great relationship. Everybody who can has been supporting them in that process, and it stays our number 4 market. I think Rosie's trying to give me a hurry up here and I'm way behind. This is how we think about our market development. So these are our mature markets. So making sure our brand's got recognition. This is where we get market access. So UK, $1 billion of access 1st of July. Imagine if we could do something similar in Europe. These ones here are the ones that we're working on. So in here, the one that's probably the standout is Vietnam. So when we think about Korea, 20 years ago, Korea was a live export frozen quarter beef market. And now we think about it as being the same as Japan. We send exactly the same product to Korea that we send to Japan. 20 years ago, frozen quarter beef, live export. Vietnam is very similar, except we send live export. It's one of our growing high-quality live export markets, but we already send them quite a volume of box beef and high-quality box beef. They're already buying Wagyu product, for example. So how do we think about a country like Vietnam to be thinking more like Korea in 5 or 10 years? Right? So it gets up there. So national cattle herd, we're going to see significant rebuild. And this is driven by a couple of things. Obviously, the seasons are fantastic, but it's also increased productivity. So you think about all the productivity things that we've been putting in place as an industry in the last 20 years. So controlled mating, preg testing, supplementation, nutrition management, better heifer management, all the work being done in things like NB2 around calf survival, that drives this much faster. Right? So our productivity has a huge impact on herd rebuild, and obviously the season's having a big impact on that as well. This is the updated graph that'll go in the projections today that said it's even going to happen. So this is one I used last week. All right. So we're saying we're going to be at 26 million in 2021, and we're actually up that already to 26 and more change, nearly a half. So this is the one that's going to be in the projections update, which will come out today. So we think it's even faster than what we thought 6 months ago. Adult slaughter, this was the one I used last week. We thought we're going to get to 6.3 this year. We're actually only going to get to 6. All right, so we're going to have even less slaughter than what we thought, but that's going to recover quite a bit quicker than what we actually were predicting last year as well. So we're going to come off a lower base and get to nearly the same area, but further by 2023 than what we were planning previously. This is one of the things that's really interesting around productivity, and this is partly season. Obviously we've got better conditions, but it's also increase in livestock going through feedlots for the reasons I was saying before, to get better consistent quality product. 20 kilos extra in carcass weight. Anybody want to have a guess? So we sent 150,000 tonnes of product to Korea last year. Anybody want to have a guess at how many tonnes that 20 kilos is worth? Even off the lowest kill we've ever had. Quick math, 6 million head, 20 kilos, 12 million kilos, 120,000 tonnes, right? So we've got a position now here, right, where carcass weight has produced, the increase in carcass weight is providing nearly as much production as our beef exports to Korea. People say, what's the value of increased productivity? This is the value of increased productivity. So average value of what we're producing, on average, what we're selling on a per kilo basis, is about $8 or $9 now. So think about the value to the sector return of that increase of 20 kilos is quite substantial. And this is what we're looking at as far as our production's concerned. So these are the increases that we've seen over time, and the kilos that we then see produced as a result of that. So significant increase in production and productivity. And so yes, it's responding to the season, yes, it's responding to demand, but it's also reflecting our ability to do that. So it's reflecting our improved systems and processes and connection, better connection to the supply chain. So, you're the first people to see this, right? This infographic turned up, as Rosie knows, trying to do my presentation on my email this morning. So slaughters down to 6 million, carcass weights are up, like I said, about 20 kilos. Production's down, right, but proportionally not as far down as the kilos, and our exports are going to be about 918,000 tonnes for the year. Pretty good looking year for next year. Normally a rainfall graph would be exciting in somewhere like Alice Springs, but I'm guessing given what's happened the last 10 days, there's not much news I can tell you about the rain, but it's pretty positive when we think about this is a chance of exceeding our median rainfall, and a big chunk of our production areas. So we think about where our cattle sit, so big chunks of our production area sitting in this 60, 70, 75% chance of increasing or beating our median. So the industry's in fantastic shape, and I think if you take nothing else out of my bit from today, we're in good shape. There's really good reasons why we're there, because we've done such fantastic work as an industry in the last 20 or 30 years. This is the result of the good work and the efforts that we've done. We've got to stop being so surprised by it. And there's an opportunity for us to really take advantage of it and exploit it, right? We're in a position where we should be driving hard, reset our base, reset our expectation. And why can't the majority of our positive positions now be the new base? Why do we have to be thinking that, it can't last forever? Well, why not? Let's do everything we possibly can to make as much of it as we possibly can last for as long as it can. So, and I think we've got, this chunk of time, and it's 3 to 5 years, where, we can really lock in the benefits that we're seeing now. A few things that we're doing to respond to the changes is this adoption approach. And one of our challenges is we've got so much information and so much material, but the adoption and use of it is limited compared to how much we have. So while it's important that we invest in these new, exciting, fantastic opportunities, we've also got to make sure we continue to invest and push on the things that are that we already know that are really important. And and it's even simple things like phosphorus. And I've talked to this a bit the last 3 or 4 months, particularly, where there's incredibly good evidence that if you're in a phosphorus efficient country, you spend $1 on phosphorus supplementation and you get $7 back. Right? I'm not sure if there's a better option for putting $1 anywhere else. So, and that's a pretty simple is not the right term, because it does take some effort to do that sometimes. But it sounds like a simple base level type solution. But imagine if we got the benefits across the whole industry of appropriate phosphorus supplementation or similar, which increases cow fertility, decreases cow mortality, increases heifer rebreed rate, decreases heifer mortality, increases calf survival. And it's not by 1 or 2%. In some of those cases it's by 10 or 15 or 20%. So you imagine if we shift the industry 1 or 2 or 3% by those sorts of things, the impact that it can have. You see what 20 kilos of carcass weight does. It creates a whole new market nearly the size of Korea. You get the same sort of benefit by increasing your heifer rebreeding rate, reducing your cow mortality rate. So how do we actually find ways to get that information out there? So things like today are really important. These longer term short-term programs, but then these longer term supported programs. So the demonstration sites are incredibly important, and the profitable grazing systems, and then making sure we've got tools and enablers and resources to support that. These bigger programs of work, like the Research Council, so WALRAC, NABRAC, SALRAC, and how we actually feed into those programs, how important they are, and this connection back to the production sector to make sure that we're focused on the right things in in the right way. And there's just a couple of slides showing how we're moving things through the system, and a couple of good examples where, on a regional basis, where we've got programs which are strategically aligned, but they're pulling together multiple operators and multiple groups to push towards a common end. And that's why things like this Beef Links program that's operating in WA, which has been really successful so far. It's been going for a couple of years, and it's a good example of how this partnership between the donor company, so it's matching other funds, and the University of Western Australia are actually engaging more effectively and providing better uptake and adoption of information. So going forward, it's this focus on how can we lock in and drive the doubling of the value of Australian red meat sales. Carbon neutrality, so CN30 and the sustainability piece, incredibly important. We're doubling our investment in adoption. So Red Meat 2030 wants to double the investment in 10 years. We'll do it in 3 or 4. So we will have doubled our investment in adoption probably by next year. And there's a bit about trust with our consumers and our customers. And we've done an incredible amount of work on building up that material. So you've got the Red Meat Green Facts on your table. There's a bunch of work we've done with producers, with videos demonstrating what we're doing on the ground, what producers are doing on the ground to be more sustainable and more productive. And then this month, we've just released this current version of feedback, which should get in the next week or so. It's a much bigger version, so it's a 75-page version, and it's 100% focused on positioning red meat. So it's about social media engagement, it's about alternative proteins, sustainability, the support tools and information that we have that's available for all of us to be better armed and prepared to proactively promote the industry, but also respond and react when those that don't like us so much have a view. Carbon neutral 2030 is a really important focus for us, and as an industry, we've already demonstrated fantastic progress in the sustainability space, and we know enough already that there's a line of sight to us being carbon neutral by 2030, but it absolutely has to be done at the same time as being more profitable and productive, having intergenerational sustainability and leaving the environment in better shape. There's no point having a carbon neutral goal for our industry if it doesn't still drive productivity and profitability and leave us in much better shape, because we've got to pay for it. We've still got to feed the world, and we've actually got to have people that are prepared to do this and can do it profitably for us afterwards. Another thing we're looking at is animal wellbeing. So how do we actually get a better handle on animal wellbeing and get a better lifetime view? So rather than actually having a single point in time focus on animal welfare, how do we actually capture the whole life of an animal? So I think a good, for instance, is that we can look after our cattle fantastically, but then we castrate them or then we dehorn them. And I think dehorning is one of the worst jobs on a farm. And we look at that one thing in isolation and it's like, well, this is terrible. It's like, well, sure, I know it's terrible, but we're using pain relief and we're doing it in a humane way. And we're making sure the animals are young. We're making sure they're mothered up properly. We're making sure we're doing everything we possibly can, because we know the knock-on benefits and the positives from that are much greater. So how do we have a broader view around animal welfare? We're really focused on how we get information back to you as well. And it's not just, so things like our annual report. Right? So if you're worried about how we actually spend money and how we look after that and how people keep us accountable, read the annual report, right? That's very important. More importantly is how do we actually put information out there so that there's an awareness of what's available, there's an awareness of what's being done, so we can reduce duplication, but more importantly, increase adoption. And things like the State of the Industry report, but also this feedback magazine, that's the one that's coming out just now, we're trying to make these materials which allow it easier for you to get across the breadth of things that are being done, but also provide tools for you to be able to use them in a more effective way. MLA updates is our current way of trying to keep you informed. The last one of those is on Monday. That's it. I know I've gone over time. Sorry, Rosie and Nat. In trouble later. I'm about all day if anyone's got any questions. Yeah, James.
There's a lot of emotional discussion around levies.
Yep.
Whether they should go up or be indexed to CPI or convert to an ad valorem kind of approach.
Yeah.
Do you have any thoughts on what would be best for the meat industry, how to do it, or is that too much of a suicide thinking there?
So it's not, I'm not very good at not taking on the suicide questions, and it's actually not a fair question to me because I obviously have some very strong opinions about levies, given I've been in the industry all my life. So the formal response is, of course, MLA can't have any opinion on levies. You need to work that out yourself. That's not very helpful, though, is it? Levies have largely not changed for however long it is, 20 or 30 years. There was an adjustment to the marketing component of the levy 14 years ago, 10 or 14 years ago. But now we've got average values across the board, a couple of $1,000 for cattle, and we've got a $5 levy. So I think it's a sensible time to be having a discussion about the levies because we've got a significant increase in price and it's a reset of price. I think it's a sensible time to be having the discussion. Where we land, from an MLA point of view, where we land is not a driver for what we then might do or plan. So levies are the most important income stream that we have. Right? Producer levies, the most important income stream we have, no question. Right? But they're not the majority of our income. So we have 4 income sources. So producer levies, processor levies, which we use to match R&D with, commercial contributions, which are for matched research and development, and then government matching R&D funds. So, and the producer levies are all up about a third of our total revenue. There's about a third from government matching funds and about a third from those other sources. The reason why we can do all of those other things is because we're responsible for the producer levies. Right? So even though it's only a third of our income, it's actually not only the most important third, it's also the third that allows us to do everything else. Whether that goes up or down shouldn't have a material impact on what we actually do with our program. So part of what we're also doing is looking at what else can we do to leverage the funds that we have to get better impact. So we're testing a R&D program at the moment where we've contracted a commercial entity. They're actually managing and contracting the researchers. We actually have an umbrella research agreement with them. We have an umbrella commercialisation agreement with them. They have match funds coming from a global NGO, and all we're doing is matching their funds with government matched dollars. So a new source of funding for research, but because we're matching those dollars, we can demand that research, number one, has to have a material impact and be focused on benefit to the red meat sector in Australia. So we can actually use our position and our ability to co-fund a program where money's coming from another country to provide benefit to our industry. So yep, we should have a conversation about levies. Absolutely we should. Is that going to have a material impact on what we're doing going forward? Well, if it changes, maybe, but more importantly for us, we've got to be thinking about what are the other ways we can leverage the investments that we have to get better value from the bucket that we've got. We have a lot of money, and I know people look at it and think we've got a lot of money. In the whole scheme of things, we don't have very much. Our industry turns over $32 billion a year. Right? It's a big deal. Our industry is a big deal. And we've got $300 million that we're trying to move the needle of a $32 billion industry with. So we don't have enough money to solve CN30. We don't have enough money to solve the big issues. We've got enough to give it a red hot go, but if we can actually leverage that with other partners that allow us to do it more effectively, that's where our focus should be rather than whether there's a discussion over the amount of levies or not.
You said $6 million head slaughter this year.
Yep.
Do you have any idea what sex breakup and what's going to be male and female?
So the female slaughter is below the 47%. So that old rebuild. So, and I don't know how far below. The guys have just said it's come below. It'll probably be in the projections this week, Jeff, but it's certainly been below that 47% for a while. I actually don't believe the 47% anymore, which is that trigger which we think about the rebuild or not. Sorry, so let's some more context. If we think about the percentage of females and males being slaughtered, the theory is if we're slaughtering more than 47% females, then the herd's in decline. If we're below 47% females, the herd is in rebuild. I actually don't believe the 47 anymore because of the nature of our, because of the pricing more than anything, we've got more females coming into the market than historically would have come into the system. So you go back to 2007, when it was really dry across the north, you couldn't send a cow from Hughenden to Townsville to have her processed without getting a bill. Right? It wasn't worth your while to send a cow from Hughenden to Townsville to have her slaughtered in the 2007 dry because prices were so low and the cows were pretty poor. In 2018-19, we had cows coming from the Kimberleys to Townsville and people making decent money out of doing that. Right? So we've actually had more females come into the processing system that otherwise have never actually made it into the system. They've stayed out there to get another calf, they've ultimately died on the place. We've actually had more turnover of that older part of an unproductive part of our herd than we've had before. So that's had a disproportionate impact on the proportion of females being killed. So that's why I've ended up with, we're running at 56 or 7%, I think, Jeff, and the high numbers. But now we're quite a bit less than that 47. So I think that's why we're seeing some of that faster rebuild as well. Yeah. But it's certainly changed. There's about a 10% shift in females versus what it was 2 or 3 years ago. Yeah. Okay. All about the rest of the day. If he wants to, I know that's dangerous, but if you want to hijack me during a break or something, that's fine. Thank you.
Thank you very much, Jason.